Hello and welcome. This is the time for Bitcoin, sponsored by Invictus Capital. It's such a pleasure to have everyone here today. I am Zachary Sepharadi from Down Capital. I'm going to be one of the hosts alongside my colleague from Invictus. We have an audience dialing in from around the world, representing family offices, sovereign wealth funds, institutional investors from over 50 countries, including many of my fellow YPO members. There is a live Q&A happening at the end of the session, but feel free to ask your questions. We will address as many of the questions as possible at the end of the session. Please use the dialogue at the bottom of your screen to ask questions. Bitcoin has surged past $10,000 recently, only briefly, and has been pushing against that level for the past few days. It's the highest point since February. It's slowly edging towards a major move in price action. It continues to consolidate in what some indicate is a bullish manner beneath $10,000. The current crisis happening around the world, COVID-19, stimulus packages, and the block reward halving are apparently and seemingly driving the price of Bitcoin. It's a pleasure today to be hosting the session alongside Invictus Capital. Invictus was founded in 2017 and is grounded in the idea that investment should be democratized, accessible to everyone, more affordable, and more transparent. Using blockchain technology and a data-driven approach to radically transform the investment industry, Invictus Capital allows investors to have a diversified portfolio and reach ambitious investment objectives. I'm delighted to be co-moderating the session with my colleague, Matthew Finlayson, who's going to introduce one of our speakers. Matthew is the co-founder and head of product at Invictus Capital. He's strongly entrepreneurial with exposure to a number of numerous startups in sectors ranging from renewable energy to data science and investment management. Matthew, if I could hand over to you to introduce our speakers and begin our session.
Great, thanks for the intro, Zach, and really happy to be here. Okay, so first Dan will be speaking, and I believe he has a presentation. I'll give a brief intro now, and then Michael will follow up after that. And thereafter, we'll have some curated questions and a live Q&A. So as Zach said, please post your questions whenever you like, and we'll answer them at the end. So moving on. So Dan Morehead is the CEO and current co-CIO of Pantera Capital. Dan founded Pantera Capital in 2003 and manages billions of dollars in hedge fund strategies. He previously served as head of macro trading and CFO at Tiger Management with Julian Robertson. Dan began his career as a collateralized mortgage obligation trader at Goldman Sachs. Dan graduated magna cum laude from Princeton University with a BS in structural engineering and received the Carmichael Prize from his thesis. Interestingly enough, I also have an engineering background, so glad to listen to hear what you have to say, Dan. Over to you.
Thanks so much. It's so fun being here with Mike, because Mike and I did go to college together and worked at Goldman, and in the early 90s worked at Japan. And Japan is a very important place, and I feel like we've seen this movie before, and that's why both Mike and I are super excited about blockchain and Bitcoin in particular, and also a lot of other global macro investors like Paul Tudor Jones that are getting into it, because we've seen actually what happens when countries do policies that are now global. And when we lived in Japan, Japan invented a lot of the policies we're all dealing with now. They invented zero interest rates, and they used to have 6% interest rates when I moved there, which seems like lifetimes ago. They invented quantitative easing, and they invented buying equities with printed money. And the punchline is, it's terrible for the value of the paper currency. And this is the value of the Japanese yen over the last 30 years relative to all the other currencies on Earth. And this is not even relative to Bitcoin or ETH or any of the cryptocurrencies. This is just relative to other paper currencies. So once you get going with the printing press, it really is terrible for your currency. And my presentation is just to give you some of the background on what's happening globally in crypto themselves. So Bitcoin was born in the last financial crisis. Satoshi Nakamoto invented it as a currency that would survive these seemingly endless bailouts of shareholders by the public. And in the very first block of Bitcoin, the first time Bitcoin was ever created, Satoshi put a quote from the Times of London about a bailout. He was outraged, or she or it was outraged, that they were spending 50 billion pounds to bail out shareholders of banks. The US is printing $50 billion every 4 days now. So it just shows how fast this thing has changed. The one thing that's changing very slowly, I think, is economists' understanding of how big this, the economic impact of this pandemic will be. There's a lot of talk about how it's going to be a V-shaped recovery, how quickly we're coming back. The chair of the Fed said that we should be back by the middle of next year to our crisis levels. And this is just to give you a sense, I really, as a macroeconomist, I unfortunately am very worried about the speed of this recovery. The US economy as a kind of a proxy for the world is going down at a 41% annualized rate right now. It's just numbers that have never been heard before. From that level, I think it's going to take 3 or 4 years to recover the pre-crash GDP level. The last recession in the United States, which was actually the first global recession since the war, took about 3 years. I think this one's going to take much longer. And so if you have policymakers that are predicating their policy based on expecting everything to just kind of pop back to normal very quickly, that just means there's going to be more policy. And on the next slide, we have an indication of what US GDPs look like over the last 25 years. It shows that the previous recession, is really just a blip compared to the thing we're dealing with. So a lot of the policy response is using the old-fashioned tools of fiscal and monetary policy. Those policies have worked in a lot of different circumstances, but the underlying cause of each of those recessions were either a lack of credit or a lack of income. Fiscal and monetary stimulus are really good at affecting those types of policies, but we're dealing with an invisible barrier to trade. And so cutting rates doesn't help. If the Fed cut 1,000 basis points, I'm not going to the movie theaters tonight, right? So we're going to need a much bigger policy than anyone is even currently estimating. And the impact of that policy is to inflate the price of things that cannot be quantitatively eased. This is a graphic of the major asset classes year to date. Things like oil, commodities have been totally killed. The proof that this fiscal and monetary printing is having its impact is stocks are now up on the year. Let's take a quick peek at that. Corporate profits are down 70% and could be down for years, but stocks are up. And that means there's just a lot more paper dollars chasing a fixed quantity of S&P shares. And so other things like gold, which literally do have a fixed quantity, are up. And Bitcoin is up 35%. And it should be mentioned that there are other currencies in the cryptocurrency sphere, like the second largest one, Ethereum, which are up 85% this year. And I think this is just the beginning of a couple of year rally. I think we're going to see, potentially hundreds of % return. And going back to the theme of global macro investors getting super bullish on Bitcoin, we just had a very important event for our industry. Paul Jones came out with a very thoughtful investor letter 2 weeks ago, where he said that Bitcoin reminds him of gold when he first got into business in the 70s. And that is a theme we've been on since the beginning, is that Bitcoin is essentially the gold of the 21st century. There's even a popular book by the New York Times columnist Nathaniel Popper called Digital Gold. Bitcoin can do everything gold can do, but it's much more dense, it's much more transferable, all those things. And so this is just an indication of how asymmetric this trade is. In investing, you're always looking for trades where, sure, there's some downside, and in the worst case, you could lose 1 times your money, but you could make 10, 20, even our first fund's up 130x. It's a very, very asymmetric trade. And if Bitcoin, which is worth 200 billion right now, gets even a small chunk of the gold market share, it's going to go way up. And it's also competing with Visa, MasterCard, with remittance, all these other different use cases. And the proof that this is becoming institutional focused is on the next slide. The open interest in the CME, which is a good proxy for institutional investors, has hit a record high. It's screaming up. And that's just showing that it's now essentially safe to invest in crypto. When Mike and I started pitching this in 2013, people would say, hey, there's no custodians, and some other issues that made it easy for allocators to dismiss Bitcoin. But now when you have the New York Stock Exchange doing Bitcoin custody, of the Chicago Mercantile Exchange, companies like Fidelity, makes it so much easier to get invested, and you're seeing record inflows. The reason one should think about this is when I started as a bond trader in the 80s, bonds were completely uncorrelated with everything else. I came to work and only thought about bonds. And I didn't think anything about what equities were doing. I couldn't care less what gold was doing. I didn't know what oil was doing. And now portfolio theory has been so successful that we basically all have the same portfolios. Everyone owns basically the same thing. And so when there is a shock to the system, like an unexpected virus, all risk assets go down, and they go down quickly together, and correlations go very high. In Bitcoin's case, it is very correlated in very sharp downdrafts with the S&P as a proxy for risk. And this shows the price in log of gold, Bitcoin, and the S&P over the last 6 years. And in these red bars, that's when the S&P is having a downdraft. And yeah, Bitcoin is, for a very short period, very correlated. And historically, in these 5 different times, Bitcoin has been highly correlated with stocks for just 32 days. And then after 71 days, it kind of does its own thing. And we are seeing that now. We're more than 71 days into this current crisis. And on the next slide, we have the results. It's essentially Bitcoin is uncorrelated with all those different assets. And as allocators, what you're looking for is something with a 209% 9-year compound annual growth rate that has zero correlation to anything else. And if you could find, an asset like that, you got to have a couple percent of that in your portfolio. And that's essentially the punchline. And why now? Bitcoin's been around for 10 years. The fundamentals are lining up with the technicals, with the global macro. And the first slide is an index of 7 of our own private portfolio companies that help people use Bitcoin to transfer money around the world. And this is indexed to 100 in November as kind of a baseline. And you can see as soon as the pandemic hit, bank branches shut down, all kinds of kind of old school financial institutions ceased functioning very well. But Bitcoin still works perfectly. You can still move money around the world. You can still use it. And so we've seen an 80% surge in the value of remittance done on the back of Bitcoin. The next question is price. Bitcoin goes through these wild price cycles. It goes up 1,000% and it goes down 80% every 2 or 3 years. And yes, that's different than other asset classes. But if you're viewing it as a call option on the future payment rail of the world, volatility is great. We're currently at almost as cheap as we've ever been. And this is a graph of the price of Bitcoin relative to its 9-year logarithmic regression. And there are some times, like in 2013 and 2017, when it was massively overpriced. Right now, it is massively underpriced. It's at the 8th percentile. It's spent 92% of the time closer or above the index. And then the other thing that's going on, which is really important, is right at a time we're having quantitative easing of cryptocurrency or of paper currencies. We're printing more and more paper currencies. We actually just cut the supply of Bitcoin in half. And the way the formula is set up, every 10 minutes, a certain number of Bitcoin are issued. It was originally 50 Bitcoin, now it's 6.25. And every 4 years, that number gets cut in half. It's called the halving. And you can see in this graph that in the year leading up to the first 2 halvings, the markets rallied a few 100%. But in the year after the halvings, they typically rallied thousands of percent. And so the past obviously doesn't predict the future, but it makes some sense that if you have an asset, as a commodity, that there's a certain production of it, and the demand stays constant, if you cut the supply in half, it will go up in price. And the next slide has a table which shows the stock to flow ratio of the previous 2 halvings. When the first halving came out in 2012, we were cutting obviously half as many Bitcoins out of the system. There really weren't too many Bitcoins in the system yet. There's only 10 million Bitcoins. And so we're effectively cutting 15% of the outstanding stock out of the production. And so that was a pretty big hit. The second halving, obviously half as big as the first one, and there was a much bigger outstanding balance. There was 15 million Bitcoins. So it was only 5% reduction in the stock of Bitcoins. This one is half again as large, and there's 18 million Bitcoin, so it's only 2% of the stock. So those ratios are about 3 times each other. we've actually seen that in the price movement, that the first halving being 3 times bigger than the second one had 3 times bigger price impact. So if that logic prevails and we have 1/3 as much impact in this one, the price of Bitcoin will go to 115,000. And that sounds ludicrous, going up 10x, but as I said, you know, our first fund's up 130x. It really can happen in this space. The last argument for why one wants to invest in cryptocurrencies is they're such a powerful disruptor that even though they have these wild cycles, every subsequent low is typically higher than the previous low. And this is a tally of the low price for Bitcoin in each of the last 9 years. And you can see it is an asset unlike any other I've ever seen. In every year except one, the low for the year was higher than the previous low. It's further true that any investor that's held Bitcoin for more than 3.25 years has always made money. And there is no other asset I've ever come across where that is true. And then the blockchain space, which we'll talk about in the panel, is not just Bitcoin. I use Bitcoin kind of like you use Kleenex to talk about facial tissues. It's the biggest, it's the brand everyone knows, so it's easiest to talk about. But there's hundreds of other important cryptocurrencies. And then there's also investing in companies that are using distributed ledger technology to do something better, faster, and cheaper. And so we also invest in venture. And the best time to invest in venture is after a crisis, obviously. And this is a table from Cambridge Associates, which has the returns of each vintage of venture. And the 10 years prior to the last financial crisis had lackluster single-digit returns. And then the years right after the crisis had 3 times the return. And so our argument would be this crisis is the perfect time to put money to work in the blockchain venture space, and in particular in the tokens themselves. And I want to thank you all very much and looking forward to the panel after this.
Excellent. Thank you, Dan. Looking forward to opening up the Q&A. We already have a lot of questions coming in. Again, just to remind everybody, there is a Q&A dialogue, so feel free to ask your questions in there. We will address as many of them as we can. Without further ado, it's my pleasure to introduce Mike Novogratz. Michael Novogratz is the founder and CEO of Galaxy Digital. He was formerly a partner and president of Fortress Investment Group. Prior to Fortress, Mike spent 11 years at Goldman Sachs, where he was elected partner in 1998. He served on the New York Federal Reserve's Investment Advisory Committee on Financial Markets from 2012 to 2015. He serves as the chairman of the Bail Project and has made criminal justice reform a focus of his family's foundation. He also serves as the chairman of Hudson River Park Friends and sits on the boards of NYU Langone Medical Center, Princeton Varsity Club, Jazz Foundation of America, and Artists for Peace and Justice. He received an AB in economics from Princeton University and served as a helicopter pilot in the U.S. Army. Mike, such a pleasure to have you with us today. And again, following and echoing many of Dan's sentiments, I'd love to hear your thoughts and perspectives on where we are now and where Bitcoin might be going.
Great. Well, hey, thank you, guys. And Dan, thank you. You know, Dan graduated magna cum laude and won the thesis prize, and I just graduated. And so I have spent 30 years in markets as a macro trader. Macro traders synthesize information and put it into simple stories. Simple stories to bet on, simple stories to tell. And that's kind of how I think of investing. And so when I think about what's going on right now in the United States specifically, but you're seeing echoes of it all over the world with, you know, protest and rioting, calls for justice, both racial justice, economic justice, justice in healthcare. You could use the word revolution. Now, I hope we don't have, you know, the French Revolution and they chop the heads off all the rich people. But there's a real spirit of system change, of revolution on the streets here in America. And, you know, you're seeing lots of protests outside. Bitcoin, what drew a lot of people into crypto, what drew me into crypto, a lot of the OGs, as they're called, the people that have been there for the last 11 years, really was this idea of systems change. It was Satoshi and his, group of friend or her group of friends, whoever Satoshi was, saying, I don't trust the system. I think there's a better way to do things. It's a miracle in lots of ways that 11 and a half years ago, Satoshi writes this paper. Today, there's over 100 million people around the world in every single country and every single village that owns at least part of a Bitcoin. This idea of a decentralized hard money, a different currency system, because we might not trust entirely the existing system, has taken root. And when you think about stores of value, right, gold being the other big store of value that's semi-liquid, but also uniform. Because, art is a store of value, real estate's a store of value, but they're not uniform. Gold is uniform. It's the same no matter where you get it. Bitcoin is uniform. They have value because of the social contract. They have value because we say they have value. There's not inherent value. You're not using gold to build houses or bridges or conduct electricity, right? You're storing your wealth in it. And Bitcoin has kind of found that same lane. And there are very few assets that get that lane, that are worth something because we say they are. And so when you think about Bitcoin, and you think about that 100 million people that own a piece of it, think of them as advocates, as salesmen of convincing other people. And so it's in some ways this amazing viral network that is selling this story. Now, the story is easier to sell when the macro tailwinds are at its back. And so there are two really strong tailwinds right now. There's the tailwind of what Dan talked about, of central banks and treasury departments printing money. My mother used to always tell me money doesn't grow on trees, and right now it does. The numbers of fiscal deficits are staggering. Right? We're going to have a 20-25% fiscal deficit in the United States. Only World War II if we get close to that. But you have to also add to the printing money, what will the political response be? So in 2008 and 2009, we had QE1 and then QE2, and everybody worried a little bit about debasement of fiat currency and inflation. I remember one of the great investors in the world, Paul Singer from Elliott Advisors. He took an ad out in the Wall Street Journal, literally saying that Ben Bernanke should go to jail, that he was a traitor for doing QE, that he was going to ruin the system, and that we were going to have this crazy inflation. And yet we didn't. And so you ask yourself, well, what was the political response then? And here in America, it was a thing called the Tea Party, right? The Tea Party was a fringe group of Republicans who said, no, we can't keep spending our children's money, our grandchildren's money. We need to be more fiscally conservative. And so there was a check on the Treasury Department. There was a check on President Obama's ability to keep writing checks, to give money away. With Donald Trump's election in 2016, with Brexit, with the sense that globalization needed to change, that it wasn't working, the Tea Party in America literally got swallowed up and spat out. It doesn't really exist. And the Republicans here started spending money like crazy, big tax cut, big money spending. So much so that we were running a 5% budget deficit before the COVID crisis. So now you have two crises. We have a COVID crisis, which has pretty much stopped work for a 3-month period. We're starting to pick back up slowly. But that was a global crisis. We have a breakdown in relations with China that is semi-permanent. That's not going to get put together real soon. So trade going down, and now we have this racial, moral, economic liberty crises, right? And the political response has to be populist, left, right? It's okay. We need to make college more accessible, if not free. We need to take student debt and wipe it out. Say, yeah, because it's been unfair. We need to potentially pay reparations to the African-American community. All of these things expand the deficit, don't shrink the deficit, right? It is really hard to see in either case, and I fundamentally believe Donald Trump will lose the election, that he lost the election a few weeks ago when he fired tear gas on his own citizens on Lafayette Park. I think there was a shift in consciousness in America, and I think he's going to get wiped out. But even if he doesn't, even if he wins, neither party is going to be fiscally conservative. They are going to spend, and certainly between now and the election, they're going to spend. And so there are no adults in the candy shop right now. The kids are pulling out every bit of candy they can and handing it out. And all of a sudden, trillions seem like matchsticks. You know, $1 trillion used to be a lot of money. And we are now, $3 trillion supplemental budget, $1 trillion. And it's not just us. Japan has the biggest fiscal stimulus they ever had. China has the biggest fiscal stimulus they ever had. And so we've got a globe that's throwing kerosene on this fire. And assets are going to go higher. Bitcoin as a hard asset is going to go higher. And so the second part of the story I want to talk about before we get to the Q&A. So it's got this macro tailwind, but then there's a second thing happening, and it's just maturity. I call it adoption. When Bitcoin started, as Dan said, like we try to sell Bitcoin to people, it looked like we had 3 heads. Wait. And so it really was a people's revolution, right? 98% of total crypto was bought by retail. It was bought by Mr. and Mrs. Watanabe, by the local guy who didn't really have stocks, right? It was bought by young people. Very few 50-year-olds have a bread wallet or a Coinbase account. And what has happened, like in any new asset, it slowly gets some pioneers. You can give Dan a lot of credit for being a pioneer. Some pioneers get involved. It has its own community, and slowly you bring in more people. Paul Tudor Jones buying it was important, not because it was Paul himself. It was important because he bought it in his hedge fund, and he publicly said he bought it in his hedge fund. So there are a lot of people who bought it for PA, but all of a sudden now he's bought it in a fund. So every other hedge fund who wants to buy it, they have air cover. They might be wrong on the price action, but they're not going to be called stupid for having done it. And so he's pulled the stupid, he's given people stupid insurance in some ways. The Yale Endowment, David Swinson, who's one of the most famous asset allocators ever, he made an allocation to Paradigm, a crypto/venture fund. And so he's got into Bitcoin. Harvard and Stanford have gotten Bitcoin. And so we're slowly seeing adoption. The next big level of adoption is going to come in 2 ways. It's going to come from the registered investment advisor community in the United States. The bulk of the money of the West, of the US and in Europe, is owned by 50 to 80-year-olds. It's not owned by the kids. It's not owned by, millennials or Gen Z. It's owned by baby boomers and older Gen Xers. That group hasn't really participated in Bitcoin in a big way yet. Why? Because it's been hard. They can't call up their broker and say, give me some of that Bitcoin. That's changing. We are at Galaxy, targeting that group with a specific fund that has institutional parameters around it. So today we announced a joint venture with Bakkt, which is the New York Stock Exchange's custody business. And so if you can't trust the New York Stock Exchange to hold your Bitcoin, or if you can't trust Fidelity, who are you going to trust? And so the 50 to 80-year-olds are going to trust that. And so that the new institutional framework is allowing adoption in that world. And I think in the next 12 months, you're going to see a lot of that money shift into crypto, into Bitcoin specifically. TD Ameritrade has been working for a long time to allow you to buy it just on their platform. The moment they do, and I do think they'll do within the year, Fidelity and Schwab and the rest of the electronic platforms will say, hey, you can buy it just like Robinhood can. Right now, you can't go on your Fidelity, even though Fidelity is involved in crypto, you can't go on your Fidelity platform and buy crypto. And so they've been slow, but it's changing. JP Morgan and Wells Fargo Bank this year, for the first time, said we'll bank crypto companies. So they're going to bank Coinbase. That's a big, big shift. The other adoption shift you're going to see is Facebook, right? Facebook is coming out with the Libra project, which is really going to just be a series of stable coins. But the more important piece of that is this thing called the Novi wallet. It used to be called Calibra, and they renamed it after me. Not really. But it's called the Novi wallet. And all of a sudden, you're going to have 2.3 billion people who on their little Facebook account on their phone can switch from dollars to Bitcoin. And again, easier access to people to buy Bitcoin. Bitcoin's not easy to buy. If it was, we wouldn't have such great value to it, right? If it was easy, you couldn't buy it here. It would be much closer to gold. And as Dan said, Bitcoin's got a $200 billion market cap and gold is 9 trillion. That is going to close over time. And so I believe two things. I believe the value of hard assets, Bitcoin plus gold, is going higher. And then I believe Bitcoin is going to eat into some of gold's dominance in that hard asset bucket. And so when I put it together, it's hard for me to look at people and say you shouldn't at least have 2% of your portfolio in Bitcoin. And if you think about it, if it goes down 50%, you'll have 1% of your NAV. It's kind of like a stock, but there's a decent chance it could 10x. Not this year, but in the next few years. And so the last thing I say is once you get involved, it gets a little addicting, and you learn more about it. Because Bitcoin is one piece of what I call the system change from the crypto revolution, right? It's, hey, can I store my value? Can I store my wealth somewhere because I'm worried about the world? I'm worried about the political side of the world. I'm worried about the money printing presses that are going crazy. There's another part of the crypto revolution where Ethereum comes in and lots of the other protocols. It's, can we build a trust layer, a trust layer that other businesses can be built on, right? Crypto was all about trust. It was about liberty. It was about freedom. It was about privacy. That's becoming more and more important. And you can see that by the rioting in the United States. And so I think we've got a perfect storm right now between COVID and the riots, between the money printing presses and the adoption. And so when you put them all together, it just feels to me like it's a great risk reward. It doesn't mean, we could flush down. We're still a semi-immature market, right? There is a tremendous amount of leverage that gets put on for short periods of time in Asia. One of the innovations, quite frankly, that came out of crypto was, companies like Binance and BitMEX that offered 30 to 1, 40 to 1, 50 to 1, 100 to 1 leverage. Regulators don't think that's great. And quite frankly, I actually think that's too much leverage and don't think it's great for the system. But because of that, you might be looking at the price as 9,800 one minute and it's 8,800 the next and right back to 94. That doesn't happen in that many assets as often as it does in crypto. It's because we're still a little bit immature in the cycle, but that's all changing. And so again, if that wasn't around, you wouldn't have the opportunity to buy it at such a cheap price. And so I say, get on the train now before it's too late. I'll stop there. We can go to Q&A.
Great. Thank you very much, Michael. And Dan as well, some great content. So I have a question so far for Dan with respect to some of the earlier slides you showed. It touches on what you were saying as well, Mike. So year to date, Bitcoin has outperformed pretty much all other asset classes by around 35%, right? Especially relative to the S&P 500, which has just touched even this week. So what do you think has contributed to Bitcoin's outperformance? And importantly, what do you think will sustain this performance going forward?
Yeah, I think it is the unlimited quantitative easing. Mike mentioned we had QE1, QE2, and now it's basically QE as in approaches infinity, where the chair of the Fed literally said it's unlimited. They will print as much money as it takes to keep the economy going. And so as you print more and more pieces of paper, it takes more pieces of paper to buy the same fixed quantity asset. A great example of that would be the oldest currency on earth is the British pound. For almost 1,000 years, it was convertible into a pound of sterling silver. And now it takes 184 pieces of paper, British pounds, to actually buy a pound of sterling silver. And I think that's what you're seeing here in the markets. As you print trillions of dollars of paper money, it takes more money to buy fixed quantity assets. And Mike raised a great line about all the trillions we're spending. There was a line from a US senator, $1 billion here, $1 billion there, you start spending real money after a while. And that was, 1,000 times ago. And now we're doing $1 trillion here, $1 trillion there.
Yeah, that totally makes sense. And it's very interesting to note, I actually didn't realize this, but in your presentation, you saw that the halving block had ingrained in it that the Federal Reserve is going to be printing trillions of dollars, which is a very neat callback to what was in the first ever Bitcoin block mined in 2009, saying basically the exact same thing.
Yeah, I thought that was very, very stylish action by the pool that printed that block, is to quote the 2 trillion stimulus. And again, I think it's very important. The current block was complaining about 2 trillion of stimulus. Satoshi was complaining about 50 billion of stimulus. This is just where it's completely different orders of magnitude.
I actually wrote that down on my notes to steal from Dan for my next presentation, because I think it's a great punctuation of what's going on.
Yeah.
So, Mike, actually, last time I saw you here in Dubai, you'll recall we sat down with some interesting individuals, including a couple of the guys from the Telegram team. You mentioned Libra, you mentioned mass adoption. This is one of the projects that was, a lot of people were hoping was going to be putting crypto and into the pockets of hundreds of millions of users globally, but it faced significant challenges in the courts, was sued by the SEC and lost. And you've highlighted some of the challenges around regulators. What are your thoughts on the regulatory challenges that some of these projects are still facing?
So it's interesting, Telegram did the biggest ICO, or the second biggest ICO maybe, that was done. They tried to do it by the book. The SEC looked at what they did and said, you own too much of it yourselves to say this is not a security offering, and it's not decentralized, and you can't issue this in the United States, period. And they decided without the United States, they can't really participate. There's too much liability. In some ways, it's a real tragedy, because we were going to see quickly how fast a community of 200 or 300 million people started using a crypto. I don't think the world needed another crypto. Matter of fact, I think, quite frankly, and I pushed those guys, they didn't necessarily listen. If they had just put Bitcoin on their platform and a stable coin, very similar to what Facebook will end up doing, you'll see their users use it all the time, right? Money will fly back and forth within the chat system in the same way kids in the United States use Venmo. They wanted to have their own ton token because you can make a whole lot of money doing it, right? And so they're commercial people. We don't really need another blockchain. There are tremendous amounts of blockchains being built. We're not going to have them all work. In the long run, I think, maybe Ethereum, there's the EOS blockchain, there's Definity, there are a bunch that have come out. I don't think there'll be just one, but I think it'll be hard to sustain those communities unless there's a tremendous amount of use case around those things. Right now, all the use cases mostly speculative. Ethereum has decentralized finance being built on it. It's about $600 billion worth of GDP, if you want to think of it that way. So it's still small. The stablecoin business has moved over and is being run on Ethereum. So that's a plus for the Ethereum blockchain. But the real kind of revolution of what will happen in 5-6 years isn't going to happen for a few years, because it takes a while for these blockchains to be faster, to be more viable, to be able to scale and to have businesses built on them, right? And so you should value those things in a lot of ways based on their network effect. The more people that are using them, in the long run, they'll be more valuable. Very similar to Facebook. let me get back to the regulation question because I got off guard. The current chairman of the SEC has been relatively cautious about crypto. I think we're not going to see monster changes until he goes, and I think he will go at the end of this year. Lots of people at the SEC underneath him are more positive. The Treasury itself has shifted, right? There was a meeting right before COVID broke at Treasury with Jack Dorsey and Abby Johnson and Pete Brigger and Wences Caceres and Brian Armstrong, all these, and Jeff Yaz, all these people that participate in Bitcoin that have huge reputation outside of the crypto community, right? Jeff Yaz runs Susquehanna. He's the richest man in Pennsylvania. Abby Johnson from Fidelity, Jack Dorsey, all know who he is. And they went down to DC and they talked to Treasury about Bitcoin. And Treasury is a lot more willing to entertain the idea. Their big worry had always been North Korea, money laundering, KYC, ML things. And they are realizing with companies like Chainalysis and CipherTrace that these are real decent tools for law enforcement. And while it might not be as tight as the banks, it's certainly a lot better than cash. And so you're seeing an opening, I think, certainly in the US regulatory side. Bitcoin's already been cleared by the SEC, so it kind of got through the gate, where Telegram didn't. And so you're not putting it back in a box. And I also think when you think about gold, no one at the central banks care about gold, just like they really won't care about Bitcoin. People say, oh, if Bitcoin gets too big, they'll stop it because it'll take out the dollar. Listen, if the dollar is in a free fall, there's bigger fish to fry than, Bitcoin or gold. And so I think we're a long way from real concern from the regulatory side about people buying Bitcoin. Matter of fact, they're allowing it, they're promoting it, they're trying to understand it more. And so I think you're going to see a constant thaw over the next few years.
So we talked about how the block halving has been limiting the supply and in some ways could be driving the price of Bitcoin higher. And Dan gave quite a few illustrations in his presentation. We also recognize one of the key merits of Bitcoin being its decentralization. We as an institution have been investors in a lot of the mining companies, and what we're seeing now is that the top miners after the post-halving are still remaining significantly profitable, but actually are scaling up their operations quite significantly. And what we recognize is that this is subtly leading to a centralization of Bitcoin. Dan, what would be your thoughts on the kind of institutionalization of mining? And the fact that these mining operators are becoming such large-scale players, and the difficulty that the barriers to entry that there are for that space that may be leading to a centralization of Bitcoin. Do you have any concerns around that?
No, it's a valid point that there are massive economies of scale in mining. The original conception was it was one CPU, one vote, so each person on their own laptop or desktop would be one of the people voting in the community. And now massive data centers are way more efficient than all of us doing it on our laptops. So I think it will further centralize. But the beauty of the system is that it takes the majority of the community to vote for any changes. And so miners would never have an incentive to change the system because there's 200 billion of value in the system. And so it should be relatively stable, even if the end state is, only a handful of very, very sophisticated miners.
To follow that up with another question, I see there are a few users posting in the Q&A with concerns over the competition to Bitcoin and ETH 2.0, potentially being a concern. So I guess there are two questions within that. The first one would be, how do you think of the rise in other blockchain technologies potentially being competition to Bitcoin itself? And second to that, how do you think of the saying, blockchain, not Bitcoin, with respect to portfolio allocation? Do you think that crypto assets are a really good proxy for the network itself, or the entire blockchain network, or would you recommend that people also look into venture alongside just pure crypto asset exposure? That's for you, Dan, or Mike, whoever would like to take
crack at it. I have a really straightforward view on this. I think Bitcoin has its own lane as digital gold, and listen, if it goes up, it will drag along other cryptos to a degree, but in both the medium and long run, the other cryptos need to create value, right? Just like on the periodic table of elements, only gold is the only element that gets valued just because it's gold, right? It doesn't have to do anything. Every other element on the periodic table gets valued because we use it, right? We use copper to do all kinds of things, and the value is a use case. And so I really think right now, a lot of the value in EOS and Ethereum and the other blockchains are there partly on speculative. People do believe they're going to be used, and the growth of those assets is going to come when they prove more use. So when you see more people building, when you move from ETH1 to ETH2 successfully, that's going to drive energy in. There's a different universe of people in those, right? I can name 20 billionaires that made their money outside of crypto that are big Bitcoin advocates. If you go on Jack Dorsey's Twitter, underneath his profile just says Bitcoin. Doesn't say anything else, just says Bitcoin. It's pretty cool. And so there's this community of people in Bitcoin that literally see this as part of their macro portfolio. You can't name one other Ethereum or EOS, people that didn't come from the community, right? So these are more organic-based communities that are building. Listen, I think Ethereum, the chart looks great, the vibe feels good. They're making lots of progress, and so I like Ethereum and I own Ethereum, but I think it's a very different bet. It's more a venture bet. Then I would strip it again. We have a lot of our money. I actually probably have 40% of my total crypto exposure in venture. I'd like to hear what, I'm guessing Dan is probably similar, but because I think venture can get split in a lot of buckets. There's the architecture that needs to get built for this stuff to work. As we move to even a stable coin based, a dollar based or a euro based or a yen based crypto dollar, crypto yen, you still need all new architecture, rails and security and staking and lending on that stuff that doesn't exist in the current financial infrastructure. And so there's a tremendous amount of opportunity to invest in venture around what will be the future, the architecture of I think both the consumer and financial world, 10 years down the road.
Matthew, I'd say that, in our Bitcoin community or crypto community, there's a ton of passion about it. And there are a subset of people called Bitcoin maximalists that almost have a religious zeal about how it has to be Bitcoin. My view, and especially for an audience like this who are institutional investors, is Bitcoin's really important. Like Mike says, it'll be the digital gold. But there are hundreds of other cryptocurrencies, and there are probably 1,000 venture opportunities in the space. And a rational investor doesn't put all of their chips on one thing. It's kind of like in the 90s being a Yahoo maximalist. That would have been crazy, right? Yahoo was a cool company, but there were 30 other important companies on the first wave of the internet. And that's the same here, is a portfolio allocator should have obviously a large exposure to Bitcoin. It's our largest exposure, but you should also have exposure to 20 other important cryptocurrency tokens and a portfolio of venture.
Great. So picking up a question from the Q&A, and I'll start with Dan, but I'd like to pose this to both of you. There are several questions around Bitcoin and digital asset adoption and the East versus West kind of divide that is emerging on that. And it does seem that rhetoric and recent developments are demonstrating that the next battleground for the trade war, the U.S.-Sino relations, will be the capital markets and the monetary system, where the U.S. figures that it has a very dominant position. But We touched upon, again, institutionalization. We've seen institutions in the East start to be more proactive in adopting digital assets and adopting DLT infrastructure. We've seen adoption, mass adoption in places like South Korea, largely outpace the U.S. To what degree do you see the West falling behind on digital assets, or would you agree with that statement that the West may be falling behind? And to what degree do you think that Western institutions have laid the groundwork for exactly a decentralized system and for a DLT-driven financial system?
Yeah, it's a hugely important question that the U.S. and other Western allies have basically controlled finance for a long, long time and can exert their will to some pretty far-flung places. But the current system is pretty clunky. You know, in the United States, it takes 3 hours to move money on FedWire. And if, one person in New York wants to send money to somebody else in New York, it's actually quicker to go to the bank and get a suitcase of cash and physically walk down the street than it is to send it electronically. Cryptocurrencies can send money in essentially a second. So they will replace the clunky fiat currency systems we have. And I think it's no coincidence that days after Facebook announced their Libra project, China announced their digital currency project. And there is a race on. And the former chairman of the CFTC, Christian Carlo, did an excellent op-ed in the Journal saying it's America's Sputnik moment, that it's game on now, and different nation states are going to build the payment rails of the future, and it is incumbent on the West to build a digital currency that does compete with the Chinese one or other countries that will bring out. Because you can easily see a world 10 years from now where at least all payments in China, but maybe in the region or in Africa or potentially the world, using the Chinese cryptocurrency, and it would be nice to have a competitor to it.
Yeah, I think, make no bones about it, and it's an unfortunate thing. I mean, I spent 8 years of my life in Asia building bridges, and we are going backwards. We are moving towards a Cold War of sorts with China. And you look at Chinese fintech, they have just kicked the butt of U.S. fintech. I mean, from insurance stuff to payments to, it's shocking how far ahead Chinese fintech is ahead of U.S. fintech and digital adoption. We're 3 laps behind. But Treasury certainly got it. They are not putting a stiff arm in the face of Facebook anymore. Libra is going to get launched this year. I would bet you in 24 months, dollar-based stable coins are a much bigger business. So there's USDT, those guys, USDC, I always get the initials wrong. That business is going to grow. And I think Dan's right. It's going to be a bit of a race. And listen, there's a lot of hybrid competition, right? Venmo is the app that every one of my kids just live on. And so Venmo isn't crypto, but it's digital. And so we'll see how this all plays out. There's not a playbook. It's going to be constructive capitalism, and some guys will win and some guys lose. What's pretty interesting is a lot of those business models, Venmo's included, all look really good when you had 2 or 3% interest rates. And at 0% interest rates, which might last for a while, those business models suck. And so, it's one of these things I think you got to keep buried in. It's going to be an interesting arena to watch, but it's not necessarily clear how it plays out.
Interesting. And a question for you, Dan. Outside of just the fintech kind of competition going on, what kind of interest are you seeing on the institutional adoption front? What barriers are investors still facing in gaining access to these types of assets? And what's your opinion on the market infrastructure, whether or not it's mature enough for proper institutional adoption?
Yeah, that's a great question. I would say it clearly is now. And Mike and I definitely got some brain damage in 2013 pitching endowments to buy like Hechler-Fayd'herbe Bitcoin fund. the change is back then there was just one fund manager in the space and there was just one asset, and that's not great for portfolio allocators. Now there's you know, a half a dozen fantastic firms in the space. Each firm has token offerings, venture offerings. Our firm, for example, has 4 different types of funds, and each of those funds has, you know, 10, 20, 30 assets in it. So you can really build a portfolio of assets, which is very different than, you know, 6 or 8 years ago. And then the big change is custody. Like Mike said, you know, 3, 4, 5 years ago, if you tried to pitch your foundation or endowment investment committee, they would just say, hey, well, there's no SEC regulated custodian or no custodian we trust. And now you have big names like the New York Stock Exchange or the CME or Fidelity doing custody. And in my opinion, that removes the last obstacle for institutional adoption. And that's why you are seeing most of the major endowments have some blockchain exposure, and, you know, other big investors are in the space.
So actually touching upon that, Dan, the point of institutional adoption and some of these, you know, and custody and other aspects being a breakthrough and being able to implement that. Part of the merits of a lot of people always challenge, well, I thought the whole idea of Bitcoin was you're going to get rid of all the intermediaries. And now a couple of years later, all the intermediaries are back in different form. Now, from our perspective, the key difference is the ability of those intermediaries to extract rents from those systems by taking those positions. But what would your view be on the fact that, you know, all these people that were talking about disintermediating are now back to the
Zach, let me answer that real quick, because I think it's a 2-phase answer, and Dan, I'd like Dan's opinion as well. Listen, when you think about why people are buying Bitcoin right now, it's not because they don't trust JP Morgan, it's because they don't trust the Fed. And so Bitcoin is an alternative to what seems to be money printing presses, right? To the debasement of fiat currency. And so that's the bet they want to make, right? It's not the decentralized DeFi bet that people are making on Ethereum and playing with DeFi. I think in time, we might see a more decentralized world, but that's not the bet people are making with Bitcoin. And so while it might feel like it's not congruous, this was supposed to be a decentralized revolution. Well, that's a decentralized money. And where I hold that money and how I secure that money, it's my own business. And right now, if I feel more comfortable holding it at the New York Stock Exchange, because I'm an old guy and I don't want to understand that, you know, someone could SIM swipe my freaking, you know, SIM swipe me and steal my phone, and next thing you know, find my password and get my keys and all the other shit. That's okay. And so if there's nothing inconsistent with owning Bitcoin and storing it at a trusted place. That doesn't invalidate the fact that there is a revolution going on, that there is a group of people that want to cut out the old trusted intermediaries, the rent takers, right? And they are rent takers. I mean, it's shocking. Every time I go to a goddamn ATM and I still love cash, even though I'm a crypto guy, they charge me $3 to take out. And if I take out 3,000 or if I take out 30, it's the same $3. And so if you're a poor guy, you know, take out $30 and you charge $3, it's a 10% freaking service charge. That's criminal. Shouldn't be allowed. It's part of the reason why people are rioting in the streets. And so there is a revolution that's going to come. That's what I will call the disintermediating and the rent takers. But, you know, in time.
Yeah, I totally agree. I totally agree with Mike. And you have to focus on who's getting disintermediated. And with Bitcoin, in Mike's example, it's the Fed that's getting disintermediated, right? That's who people are going after. And then if Mike and I want to store our Bitcoins with the New York Stock Exchange company backed, that's fine, because I don't want to try and keep my password in my head, right? It's safer that way. The best example I would say is money movement. When Bitcoin was invented, a monopoly controlled most of remittance around the world, and migrants were paying 9% on average to move money back home. And for those of us in finance, right, 900 basis points is just a number, right? But for the migrant, that's a month's wages. They spend an entire month working to pay their remittance company. And with Bitcoin, you can do it absolutely for free, but most migrants don't want to download Bitcoin QT to their laptop, right? It's not practical. So we're investing in a bunch of companies like Bitpagos and Bitpesa that help migrants move money around the world. And they don't charge 9%, they charge something like 2%. So yes, there is still a centralized intermediary, but the punchline is 20 years from now, even those companies we're investing in today will have been disintermediated, and they will be taken out of the loop, because by then all the migrants on earth will have Bitcoin or ETH or XRP on their own device, and their mom back in the Philippines or whatever has it on their device, and those will get disintermediated. So it's essentially a two-phase process.
So I hope you guys don't mind us going a little bit over time, but there are a lot of interesting questions coming in, and this has really been an excellent webinar. So as long as that's okay, got the thumbs up from both of you, just one or two more questions. We'll just go 5 or 10 minutes over. One of the questions from Vikram Rai is around the volatility of Bitcoin. Dan, you've made some indications of the price that Bitcoin could rise to. Mike, again, I understand you're quite bullish as well, but if Bitcoin is going to be useful as a means of exchange, as a store of value, or as a unit of account, does the volatility of Bitcoin not concern you? Maybe starting with Mike.
Well, no. Listen, I think as a smart investor, you kind of look at the volatility and you position size accordingly. So you heard me say people should put 2% of their portfolio into Bitcoin. Bitcoin's trading call it a 70 vol instrument right now, where you're used to currencies trading at 10 vol or less. And so I have a lot more of my portfolio in Bitcoin, but I don't have 50% of my portfolio in Bitcoin. I probably have 13% of it in Bitcoin. When I was a currency trader, and I still am, if I'm really bullish the euro, I'll have 40% of my net worth in the euro, or 50% or 60%, right? So it's volatility adjusted. And so I think, listen, over time, but I don't think anytime soon Bitcoin's vol is going to come lower. There might be periods of time, like Dan and I both think it could double this year, if not get all the way to 100,000 in the next big rally. And so you're not going to have something go 10x on a 10 vol. And so be prepared for 50 plus vol or 40 plus vol, I'll say, and then position size accordingly.
Yeah, I'd say that the reason Mike and I are so excited about cryptocurrencies and Bitcoin in particular is there's so many use cases. When a technology is disruptive, they call it a category killer. Bitcoin's a serial killer. It's going to go through a dozen different things. But the important point is it's going to do it serially. It's not going to do everything overnight. And the last thing it's going to be good at is as a unit of account, because it's going to be volatile for the next 20 years. And essentially as speculators or investors, that's precisely why we're invested, because we think it's going to go to 100,000. And something that goes from 10,000 to 100,000 over the next couple of years is terrible for putting prices on a coffee shop menu. So it's not going to be good at that for a while.
To pull another question out, and just to comment specifically on what you're saying there, Dan, do you expect then that the volatility of Bitcoin would decrease as adoption increases? And kind of second to that, given that Bitcoin is currently seen as the ideal portfolio diversifier or a completely non-correlated asset, how do you think that the value proposition of Bitcoin will change in time with respect to the answer to volatility or not?
Yeah, no, you're spot on. Is that it's a brand new asset class, and over time it's going to mature. And 10 years ago, there was only one person on earth that had a Bitcoin, and now there's 50 million or whatever it is. And if 10 years from now, 2 billion people have Bitcoin, the volatility would continue to decrease. It used to be even crazier vol. Like now with 70 vol, as Mike said, it's way below what it used to be. And Mike and I have seen a lot of asset classes like commodities, emerging markets develop over time. They start out with crazy vol and then they get really boring. And bonds being the ultimate example, we started out as bond traders. There's zero vol. Bond trading's over, right? And so, Bitcoin will be like that 20 years from now. It's going to be at, $1 million per Bitcoin or whatever, and have like 10 vol. And, we're going to have to move on to the next interesting trade.
So as we close out, I'd just like as a closing remark from each of you, maybe if you could share with us something that you're excited about, in this space. Maybe it's something about Bitcoin specifically, maybe it's something about venture related to DLT. But maybe we could start with Dan. If you could tell us a project, a company, a technology that you're excited about that you think may be a game changer.
Yeah, I'll start with a simple one. I love it. We are invested in a company called CoinMe, and it allows people to use Bitcoin to send money around the world in a very convenient way. They're basically in all the supermarkets. Like if you go on your phone and do Bitcoin near me, it'll pop up 20 different places at like Safeway or Kroger's or whatever. They're within a mile or two. And even during the pandemic, I could go a mile down the street, walk into a Safeway, feed $300 into the little Coinstar machine, and send it to friends. And it's an incredibly easy experience. It works. And so, sometimes people trying to overcomplicate DLT. It's a super scary, weird thing. It's just a way for a migrant to, put a few $100 in a machine and have it pop out in Mexico City or Manila or wherever they want it to go. And they're seeing revenues, record every month because it works. And that'd be what my closing remark would be. Satoshi invented Bitcoin as a response to the previous crisis. I think it's going to come of age in this crisis.
Yeah, there's some beauty of that synergy, that synchronicity almost of the two crises. And my excitement is a little more macro and less micro than Dan's. I was at ex-Goldman Sachs. Dan and I were both ex-Goldman Sachs, and one of my buddies who's very senior there, got me on a call with 40 of their clients. It was an informal call, but it was 40 of the most prominent macro fund managers in the world. And we were discussing macro, but we were discussing crypto. And I was thinking to myself, the chance of that having happened a year ago was zero. And now, Paul Jones is public that he's bought Bitcoin, but I know lots of other managers that have bought it for themselves, that are looking at it for their fund. And so there was a shift that's happened in the last 4 months with this COVID. And that crypto is now literally looked at as a portfolio weapon by all of the most, diverse and seasoned portfolio managers I know in the macro space and in the family office space. And so it's hard for me not to think we're going to see more and more adoption. I'm more bullish today than I have been any time in the last 4 years. And I haven't always been bullish. If you had called me in December, I would have been like, oh my God, I'm sick of this frickin' business. It's not moving fast enough. We had this weird rally in January that I didn't really understand. I understand this rally, and now I kind of see why it's happening. I believe in it. I'm putting more money into it. I'm investing more in my business. And so I want to leave you with the sense that my confidence is as high as it's ever been. And I don't say that lightly. Guys, thanks for all your time and thoughts.
Yes, thank you so much, Mike. Thank you so much, Dan. Again, we covered so much. We covered how COVID-19 has and monetary stimulus has been affecting markets, how it's been affecting Bitcoin. We've been talking about how the U.S.-China trade relations may be affecting the adoption of digital assets. We covered everything from the institutionalization, more institutional investors building positions, that the groundwork has been laid for institutionalization. We covered predictions, outlook, again, Bitcoin mining, how the block halving has had an effect. For us to have covered so much in an hour is really incredible. I cannot thank you enough. And I'd also like to give a big thank you to the team at Invictus Capital for co-hosting and sponsoring the webinar. They offer access to alternative investment funds on their platform. They've been focusing on gold and VC. I've been tracking them for a while, and it's a really great team. I'd like to invite everybody to the next AIM Summit webinar taking place on June 17th at 4 p.m. GST, Gold Standard Time. Bridging Troubled Waters, the impact of COVID-19 on investment strategies. That's going to be sponsored and led by LGT Capital Partners, with speaker Stephen Kind, and moderated by David Gibson Moore and myself. Again, thank you all so much for joining us. For everyone who asked questions that we weren't able to get to, please send an email to the AIM Summit team. We'll get to as many questions as possible. The AIM Summit team can also assist people in connecting with Dan and Mike that may be interested in having discussions with them, as well as with the Invictus team. Again, appreciate everyone taking the time out of their day to join us, and look forward to seeing you all again. Thank you.